With all its tax benefits, superannuation is a very attractive structure to build assets for your retirement. But how do you use the wealth you've accumulated in super to build a retirement income stream? That's where the account-based pension comes in. Even more tax effective than superannuation accumulation account is an account-based pension. In fact, it is a completely legal tax-free haven right here in Australia, available for everyone to use. The trick is to use it effectively. In this video, we're going to explain to you exactly how it works and give you some tips to maximise the benefit in the lead up to retirement. An account-based pension is a retirement phase of superannuation. It is a pension account that holds assets to produce an income stream for your retirement. As the owner of the account, you have flexibility over what assets your pension is invested in. You also have flexibility over how much income you draw down from the account, more on this soon, and the frequency of payments. The idea is that when you decide to retire, turning off your earned income, an account-based pension can be a replacement source of income to meet your living expenses. How long your money lasts is going to depend on a few key factors: the starting balance, how your investments perform, how much you withdraw each year, and if you take any lump sum payments. There's no lifetime guarantee, but the tax advantages can make your money go further than non-super savings. The government sets a minimum amount you must withdraw each year based on your age. The older you are, the higher the percentage you must take out, starting at 4% for those aged under 65. This table summarises the pension minimum applicable to each age group in the current 2025-26 financial year. If you start partway through the financial year, you only need to withdraw a proportionate amount. There's also no maximum cap unless you're in a transition to retirement pension, which allows you to withdraw up to 10% of your account balance each year. One of the biggest perks of an account-based pension is the tax treatment. If you're 60 or older, any income you withdraw is completely tax-free. It's classified as non-assessable, non-exempt income, and therefore there is no need to report it in your tax return. And it's not just about income payments. Investment earnings within the account, whether from dividends or capital gains, are also tax-free. That means more of your money stays working for you instead of getting eaten up by taxes. If you're investing in Australian shares which provide a franked dividend, the franking credits are 100% rebated back into the account because of the tax-free status. This adds to extra income to help fund your retirement. If you are using a transition to retirement pension, it's a little bit different. Your investment earnings are taxed at the usual 15%, similar to that of an accumulation account. But once you've fully retired, it's back to a tax-free haven. In order to commence an account-based pension, you must meet the eligibility criteria. This depends on your preservation age and working status. Your preservation age is the age at which you can start to access your super. If you were born after 1 July 1964, then your preservation age is age 60. The amount of superannuation you can access will depend on your working status. If you're between the ages of 60 to 65 and still working, you'll have partial access to superannuation through a transition to retirement pension. The maximum you can draw down is 10%. Between the ages of 60 and 65 but not working, you'll have full access to superannuation and an account-based pension. And above age 65, you have full access to superannuation and an account-based pension regardless of your working status. For more information about accessing your superannuation, we will link another video which we previously did about this topic. Even if you do not currently meet the eligibility criteria to commence an account-based pension, you should start planning for it. This includes utilising contribution cap limits to maximise the amount you have inside superannuation for an account-based pension and ensuring you're in the appropriate super fund. When it comes to choosing a super fund, you should choose a fund which offers a seamless asset transfer. This means you can transition the assets you hold in accumulation phase into pension phase without triggering a capital gains tax event. The benefit of a seamless asset transfer is that it allows you to accumulate significant capital gains on invested assets throughout your working life and pay $0 in tax by selling them down in pension phase. A very powerful strategy. The next best thing is a retirement bonus when in a pooled superannuation arrangement. This is a lump sum payment to account for some of the tax saving when you move into an account-based pension. Retirement bonuses are applicable to pooled superannuation arrangements like industry super funds, but only a handful of funds offer this benefit. There are limits to how much you can put into a retirement phase pension. This is called the transfer balance cap, and it's currently set at $2 million. Any amount above this has to stay in accumulation phase, where earnings are taxed at 15%. If you've already started a pension before 1 July 2025, your transfer balance cap might be somewhere between 1.6 million and 1.9 million, depending on your individual circumstances. An account-based pension is a fantastic way to get the most out of your super during retirement. It offers flexibility, attractive tax treatment, and the ability to tailor your income to your needs. We start preparing our clients for the effective use of an account-based pension from phase 1 by looking for an appropriate super platform to house their savings. We then deploy strategies through phases 2 and 3 of the wealth creation process to maximise the benefits before kicking off an account-based pension in phase 4. If you're not utilising your superannuation wisely, I can almost guarantee that you're paying too much in tax. If you think an account-based pension is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.